But first, let's talk about that economic data that we've gotten recently, which was the subject of today's morning brief. Sam Rowe, our editor, was in the driver's seat this morning, writing that and talking about that data that we've gotten recently and how difficult it is in this environment to sort of make sense of the numbers. Incidentally, we got another number just now, the NAHB, the National Association of Home Builders Index, coming out at 83, which is unchanged month over month. As we know, the housing data has also been a little bit choppy on the sort of supply-demand imbalance. But, we talked to Charlie O'Shea of Moody's last week about the retail sales number, and he basically said, this environment, it's really tricky to figure out what the consumer is doing. I also thought that the quote from Credit Suisse economist James Sweeney was interesting. He called it a data fog with some incoming high-frequency data atypically uninformative. So I guess, Myles, it's just really difficult to get a clear picture right now.
And in that same quote, Julie, which really is kind of the crux of the article here, Sweeney adds that unhinged narratives are circulating freely as observers cherry pick numbers to fit stories. We talk a lot on the program about the challenge, or have talked about the challenge that individual stock analysts and even S&P strategists have faced in this environment. The challenge for an individual company analyst is that you have a model for how much the company is going to grow over time. Based on what the company does or does not tell you, you may tweak that model. There has been a lack of guidance from many corporates, thus leaving analysts guessing at how they should be thinking about company growth. As a result, we have seen estimates for this earnings season woefully inadequate, just massive beats across the board. I think the rate last time we checked, something around 88% of companies in the S&P 500 reporting better than expected earnings results. The same thing happens in the economy. Economists have a broad macro dashboard for what they think growth is going to be given all kinds of different drivers. Well, right now, all of those inputs are going haywire. And so you are sort of guessing at what any 1 month's or a quarter's data may look like when compared to the prior quarter, the prior year, and certainly when compared to anything resembling a baseline forecast. And I think we sort of saw that last week in this way. The inflation data comes in hotter than expected. So you get this round of, oh my God, here's inflation. The world is ending. The Fed's behind the curve. Everything is going wrong. See, like I've predicted since 2008. Then you get the retail sales report, which comes in worse than expected, though still shows total dollar sales were the same as last month. And also, basically above trend from 2019. But that miss on data, as interpreted as, oh, well, the economy is falling apart. The Fed has no room to maneuver. The rates are already at zero. They're already doing massive QE. See, I've been right also since 2008. And so I think that is sort of what Sweeney is suggesting. The data is so noisy, Sozzi, so chaotic, that everyone can make the argument that they are right about what is happening, even if their contentions are, incoherent when compared from Wednesday to Friday, as was the case last week. And I think it's going to be a very challenging summer on that front, because this is only the beginning, probably, of what's going to be several months of, let's just call it chaotic data, I think.
Chaotic data, and also probably just chaotic trends in corporate earnings estimates on the street. Realistically, the street, most sell-side analysts are underpricing or just don't have it right either for the second quarter, because to your point, the economy is really snapping back hard, and ultimately maybe that serves as another catalyst for stocks.